These are the riskiest bonds out there. And I'm saying risk in terms of volatility, not in its ability to pay back what it owes, the debt obligation. So let's go into this. So we're going to take three bonds. We got a 5% coupon, we got a 3% coupon, and we got a 1% coupon bond. All right, so we got three bonds. Remember, coupon is just the interest that the bond issuer is paying at issuance. So it says I am paying $50 on a $1,000 bond, 5% coupon. The bond issuer is paying $50 a year until maturity, whenever maturity is. All right, so in this case, we have 5% bond paying $50 a year, 3% bond paying $30 a year, and a 1% bond paying $10 a year. That's all coupon is. It's the interest that the bond issuer is paying. It's not the yield. The yield is a coupon divided by the share price. So just keep that in mind. Yield and coupon are not the same. They're not synonymous. All right. So we're going to raise interest rates by a full 1%. 1% hike in interest rates. So that's supposed to be a 1%. 1% hike in interest rates. Who is most affected by a 1% hike in interest rates? Well, for simplicity, we know that this bond, that's a 5%. 1% is a 20% increase on a 5% bond. 1% is what's a 33% increase on a 3% bond. And 1% is a 100% increase on a 1% bond. All right? That's just that simple. So the lower the coupon, not the lower the yield, the lower the coupon, the more fluctuating the share price will be of that bond when interest rates rise or go down. But no one really cares when it goes down because people are making money. So let me give an example of that. We got this guy right here. Here's the PIMCO. Oops. All right, so here's the PIMCO zero coupon U.S. Treasury, 25-year long, and we'll talk about this here in just a second. Long-term U.S. Treasury. And look at this guy so far. It's down 21% this year. 21%. So what that meant is if interest it probably had a duration of 20%. If interest rates went up 1%, the fund would be down 20%. And that's basically what it is. So you can see right there, this fund is down 21% so far year to date. Tell me that's not crazy. So it's two things. Zero coupon. Let me show you what a zero coupon bond is. So a zero coupon bond literally has no coupon. You basically buy it at $6.50 and it matures at some time in the future at $1,000. I love zero coupon bonds. The simplicity is fantastic. You say, look, man, I'm glad you pay you Tuesday for a hamburger today. I'll pay you 2 hamburgers on Tuesday for a hamburger today. That's exactly what a zero coupon is doing. It's saying, I'll gladly pay you Tuesday for a hamburger today. But what I'm paying you Tuesday is a hell of a lot more than one hamburger, because 2 birds in the bush is always less value than 1 in the hand. So in this case, a $650 bond doesn't give you any interest rate. It just pays $1,000 at maturity. That's called a zero coupon bond. It's the simplest investment there is, guaranteed by the federal government. I love zero coupon bonds. I love them. Other than when they're long term and they're zero, and then interest rates go up. And now we're seeing that paid off handsomely against you, if that makes sense. I mean, look at that puppy, man. Woo, netta. That is big time drop off. Now, I want to show you something else, though, because it's pretty interesting. We're going to look at this guy. I think it's American Century. Let's take a look. American Century 2025 zero coupon bond. Both are zero coupons, but this matures in 3 years. What's that guy down so far this year? Like 3 or 4% or something like that? Yeah, about 4%. So if you start at $10,000 at the beginning of the year, it's down $9,500. So part 2 of the riskiest bonds are long maturity, zero coupons, low coupons, long maturities. That is the most riskiest bonds out there from volatility. Here's the American Century one. It just isn't getting crushed because it's going to mature here in a couple years anyway. So it's not far that removed from its par value. The par value will be $1,000. Can't stress that enough. So we know for a fact. Let's see, they got even a duration on this thing. Let's see. I'm not sure they do. So on a side note, by the way, this is the income distribution. 372 in 2012, 497 in 2013, 373, 328. Now, on a zero coupon bond, it's phantom income. I'm not sure how it works with a mutual fund, frankly. Phantom income means you have to declare the taxes on the income you haven't received. the income is going from $650 to $1,000. So that $350 increase amortized over the life of the bond, say 10 years. We'll just say that's what $35 a year you'll have to declare as taxable income, even though you haven't actually received it. A lot of people freak out about the phantom income. If you don't know what that is, then don't buy it. But anyway, I'm not sure how it works with a mutual fund. It looks like that's actually being paid out. And so right now, at $334 and $106 bond, that's still paying 3%. That's a yield right there. Not the coupon, that's the yield, because there is no coupon in the zero coupon bonds. I don't see any duration thing. We'll just look at holdings. That's weird. This is not an ETF. This is a mutual fund. Not sure why it's not showing duration. Strange. All right. Whatever. Duration is just the volatility. For every 1% increase in interest rates, the price of the bond would drop by the duration. I don't know why it's not showing that. Okay, whatever. All right, so that's, you can see right there, American Century short-term, relatively short-term bond versus long-term bonds. Short-term bonds have much more downside than long-term bonds. And again, the reason is because the long-term bonds have longer before it matures. Long-term bonds are always more volatile. Always, generally speaking, would be more volatile simply because they're longer before they mature. Short-term bonds, because they're less, they're closer to maturity, will be less volatile. That's all there is to it. Zero coupons, so the lower the coupon, the more volatile the bond is. Now, a lot of people say, oh, Josh, but how about junk bonds? So let's look at the Vanguard junk bond here, right here. Oops, below investment grade bond. This guy's only down 6.96% year to date. That's it. So 6.96, and that has a coupon. And does it say in Vanguard? I can't remember. I want to say 4 or something like that. But anyway, because that's a junk bond below investment grade, any kind of junk bond will be more volatile than the non-junk investment grade bonds, but not quite the same as you think. They're volatile. Don't get me wrong. 2008 junk bonds got smoked. Let's see if it gives us the average coupon. Let's go to distributions. Let's go to portfolio management. I think it did here. Average coupon 4.6. There you go. So that's obviously higher than a zero bond, but look at that, 4.6 the average coupon. It's a junk bond, and yet that's still down almost a little bit more than what the zero coupon was from American Century. You know, this is junk. It's below investment grade. This guy right here is zero risk in terms of downside, its ability to pay back shareholders, because zero coupon bonds that are owned by the issued by the federal government bonds are guaranteed to make you whole in terms of the initial value when it was issued, if that makes sense. All right, so let's just take a look at Vanguard. I want to look at, so we got zero coupon bond. We got the short-term zero coupon bond was down, 5.25. Let's look at the intermediate bond fund at Vanguard here and see what that shakes out at. Now that's probably got a 2-3%. I don't think, probably not 3. Let's take a look. So we're going to look at an intermediate fund, short term. Let's look at that guy. That guy's down 6.68, but the bonds in there are going to be, let's see what the average maturity is here. I think it's going to be probably 7 to 10 years, so it's a longer maturity bond. Let's take a look here. We're going to look at holdings. Where are we going to look? I think it's portfolio management. There we go. All right. And so the average maturity about 5 years or so, and the other one's about 3. All right, so then maybe we gotta go to short term to get a better comparison. The rule of thumb, if you want to avoid downside risk, you avoid zeros and you avoid long-term bonds, and you certainly avoid zero and long-term bonds. Just keep that in mind. Now, that's if you want to avoid short-term downside risk. Let's look at short-term U.S. bond, inflation protected, intermediate. Go down short term. There we go. Short term. Yeah, 4.07. So there you go. Short term Admiral Index. Let's look at short term Federal. There we go. Short term Federal is government bonds, I presume. Short term Treasury right there. So at 2.93, whereas the zero was down basically 5.25, I think. Yeah, 5.25. So let's see what the average maturity on these guys is. Portfolio management. Average maturity about 2.1 years. So just a little bit over with the zero coupon bond, but this is the zero coupon bond a little bit under the zero coupon bond, but the zero coupon bond was about almost twice the downside. So anyway, if you want to avoid volatility in the bond market, you avoid zeros and long term. That's just a fact, man. Hope this helps. Love to hear your thoughts. We'll see you.